We're TV 12. The people who can put you in the black also make possible in part TV 12's broadcast of Wall Street Week, your Acura dealer network.
TV 12's broadcast of Wall Street Week is made possible in part by Mellon Bank. Mellon Bank is proud to serve the banking needs of the people and businesses of the Delaware Valley.
Wall Street Week with Louis Rukeyser. Brought to you by public television stations. By CSX, the company that puts things in motion. Transportation, energy, properties, and technology. And by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, December 16. Our panelists are Monte Gordon, William Gross, and Carter Randall. Tonight's special guest is Joseph Jolson, General Partner, Montgomery Securities.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, sports fans, it may be football, basketball, and hockey on your TV screens, but in the world of money this week, it was all baseball. CBS, which lately hasn't been able to figure out how to do anything right, it's running an unaccustomed third, and this week canceled fully half its new shows, sought refuge by shelling out more than $1 billion for exclusive network broadcasting rights to Major League Baseball in the early 1990s. Now will you let your kid stop doing his silly history homework and start doing something sensible, like practicing his slider? In any event, the baseball image seemed right for the late financial innings of 1988. There was a nice double play on trade, for example. Exports rose smartly in the third quarter, and in the first month of the fourth, the overall trade deficit continued to shrink. Not quite as much as some had hoped, but still enough to reduce the gap for the first 10 months of 1988 to nearly $30 billion below what it was a year ago. And there was yet another strikeout for the forecasters of economic collapse. Retail sales again surprised the gloomy consensus with a stunning gain in November. Industrial output continued to grow, and so did housing starts. Not every sector slid in safely, though. Detroit, for instance, was troubled by falling car sales in early December, suggesting that the next play may have to be more buyer incentives. That tricky State Department hurler, George Shultz, threw a curve to Israel by saying the Palestine Liberation Organization had now met U.S. requirements for the opening of direct talks. Wall Street took the news in stride, apparently agreeing with Winston Churchill that jaw is better than war. But if Yasser Arafat does become the next improbable American hero, smart investors may want to buy producers of Arab headdresses and short Gillette. Rookie of the week was whiz-kid entrepreneur Barry Minkow, found guilty of rooking so many investors in his ZZZZ best that he faces a maximum sentence of 403 years, presumably more than enough to discover once and for all whether the legs go first. We tonight will try to hit a home run in your behalf by solving what may be the most baffling financial pitch of the year, the savings and loan crisis, whose eventual price tag to the American taxpayer may reach $100 billion. But first, let's check out the amateur pepper game on Wall Street. And as the Dow Jones Industrial Average indicates, even the computer fun and games of a quarterly triple witching day, in which 3 different kinds of options and futures expire, couldn't keep the market from slogging ahead for the 4th straight week. But the strong economic news added to concerns about possible higher interest rates ahead, and the Dow's gain was held to 7 points, making it 88 in the past 4 weeks, as the blue chip index closed at 2150.71. Progress was even more mixed for the broader market indexes, as the Dow approached the area where it topped out earlier this year. But our elves know precisely what they think. Absolutely nothing. Their technical market index, at dead zero this week, has been in the neutral zone since early November. The scent of higher interest rates helped the U.S. dollar, but it was a down week for the precious metals, especially platinum, which lost $75 an ounce on news that it will not be needed in a new emissions control device being tested by Ford. Embarrassment of the week was felt by America's male sheep on the news that they are costing ranchers at least $7 million a year because of their low sex drive. Fully 16% of the sheep were reported to be total duds, for whom presumably there will never be another you. Carter Randall, how much higher are they going to ram Wall Street?
Oh, I was just about to talk about rams.
Well, go ahead. It'd be cheap at any price.
Cheap at any price.
I'm trying to pull the wool over our eyes. Now just come out with it.
I think, Lou, Wall Street is not only in good shape, but is going to be in better shape over the months ahead. I think there's too much gloom. I think there are too many people looking for too high interest rates. I think there are too many people thinking we're going to have a recession because we haven't had one for a while.
Let's take them one at a time.
Okay.
Do you think we will get an increase in the discount rate?
Yes, but I think it's an adjustment to other rates already in the marketplace.
It's a lagging indicator.
Sure.
Do you think we will have an inverted yield curve with short-term rates higher than long-term rates?
Yes, and that is always a time to buy long.
It's often a precursor of recession, is it not?
Yes, but it's a precursor of eventually rates coming down and an improved economy as a result. So if you have a little bit of lead time, it's time to buy, not sell.
Earlier this year, you were quite specific. You said that you thought fair value for the Dow would be about 2250. Would you revise that now?
No, I would say it's about the same. Interest rates since then have gone up, but so have corporate earnings. And corporate earnings relative to the bond market, I say, still make the market valued around 2250. Now, I think earnings will go up again next year, so I'll put a true value even higher than that.
So you're getting a little more aggressive.
I'm cautiously optimistic. I think the market analysis-wise should go up. The problem is psychology and what people will in fact do. So I'm going to buy as the market declines and ride with it as it goes up.
Well, Monte Gordon always knows what the market's going to do, so why don't you tell us and then we'll know exactly what to do.
In that case, we'd all go home early.
That's right.
Well, I think that the key of the market here is its ability to resist so many of these blows that we've had in here, such as you mentioned, one of them being strengthening up the great strength in the economy. I think what the market is most fearful of is that the strength in the economy will be so great that it will force the Federal Reserve into more draconian action than even just raising the discount rate, and that could lead to a more severe recession when the recession does come about. I think that's the basic underlying fear. My own feeling is that the Fed is moving very warily in anticipation of that risk that's out there, and actually probably we will achieve a softer landing than the market thinks.
Would you expect a recession next year?
No. I don't think there'll be any recession. I'd also say I don't think there'll be a recession in 1988, Lou. But I don't think there'll be a recession in 1989. I think we will have sufficient strength in the economy to come through 1989 fairly successfully. In fact, I think the situation will improve as we go through 1989 in the sense that the weakening thrust of the economy will ease some of the fears on inflation and interest rates. I think your earliest risk of a recession is 1990. Early part.
And you think if the Fed keeps its head, it's not chipped in stone, it will have it even then?
I think that if the Fed remains sensitive to what is driving the economy in the sense of being able to try to keep a wearing pressure on what the strength of the economy is, I think you have a good chance of coming through relatively well, better than most people anticipate.
Bill Gross, you follow interest rates for a living. Is the time coming when we should start aggressively buying bonds?
Well, we're still a few months away, I think, Lou. You were talking about an inverted yield curve with Carter, and that's the point at which short-term rates go higher than long rates and presumably slow down the economy. Typically in the past, when you go back in terms of past business cycles, it's taken at least 6 months, 6 to 9 months, in order for short rates being higher than long rates to work their magic. And I think it'll probably take perhaps into the second quarter of 1989 before we start to see a slowdown and therefore a chance of interest rates coming back down. But I think we're close to a peak.
Well, we're yielding about 9% now on long-term government bonds. How much higher do you think that will get?
Well, the long bond probably could go to 9.5%. And when you move down that curve to 2-year, 5-year, 7-year notes, I think they stand a chance of maybe going to 9.75. But relative to a 5 to 6% inflation rate, that's a very restrictive rate to borrow at, and I think that, in effect, is what's going to slow us down.
Your feeling then is that a year or two from now we'll look back at 9% and wish we'd bought some bonds?
Yes, start to buy now, and as you move into the first and second quarter, hopefully you can be fully invested. That's the key.
All righty, in any event, gentlemen, it's time now to see what's on our viewers' Christmas lists. Carter, Randall, 2 related questions about cash. The green stuff, not the country singer. Hal Schultz of Salt Lake City, Utah, wants to know what advisors mean when they suggest that a certain portion of assets should be in cash. Are they talking about checking accounts, short-term CDs, or what? And Jack Lovell of Amarillo, Texas, wonders why, for safeguarding money in U.S. Treasury securities, advisors seem to prefer short-term Treasury bills to longer-term notes and bonds. Don't they all have equal protection and safety, he asks?
Okay. Well, the long and short of it is that most advisors talking about keeping a percentage in cash really mean cash or equivalent. Obviously, you should have your money earning a rate of return in money market funds or short-term instruments of one kind or another. Yes, I think it's all right to use longer-term issues such as bonds and notes for that. However, do know that they will fluctuate in value more the longer term they are, and if you want liquidity and absolute guarantees of what it's going to be worth, then being short is better.
Fair enough. Monte Gordon, Rob Blakely of New York City, is too young to be a baby boomer, and it bothers him. Growing up, he writes, I watched as the boomers' collective adolescent angst changed the world I would grow into. Soon, no doubt, the world will turn on their collective midlife crisis, unquote. He'd like to know how the demographics of these aging boomers are likely to affect the overall stock and bond markets over the next 30 years.
I'm having trouble with tomorrow.
He's on the other end of the boomer
He's
curve.
at the other end of that. Well, obviously, one of the things that does happen is as you mature, because we don't age, Lou, as you know, as we mature, we become a little bit more conservative. And one of the keys of the demographic change that's going on here in terms of what he's referring to is that the baby boomers are coming into an era when they are going to be more mature. Therefore, their demands and desires are likely to be more conservative. So I think you'll see a rise in the savings rate, which will ease some of the problems in the U.S., one of our critical problems. You probably will see a higher rate of capital spending to improve productivity because we'll have a smaller number of people coming into the labor force. Generally, I would say what you're looking at is a circumstance that will force the U.S. to remain competitive, and probably we will see lower interest rates and better financing capability as a consequence of the more conservative attitude.
So it won't be all bad for the post-boom.
Oh, no. It should, just as it wasn't after when it looked like it was going to die in 1960s, it came back later.
All righty, Bill Gross, speaking of demographics, Gerald Minata of Santa Barbara, California, says he's read recently that the long decline in the baby diaper service business seems to be ending, with some companies reporting a significant turnaround in profits this year because of the higher cost of disposables and increasing concern over their possibly negative environmental effects, plus the new baby boom the country is experiencing. Do you agree that the profits of the diaper service business should continue to expand, and do you have any investment recommendations?
Well, as usual, you've come to the right place on this one, Lou. Sue and I just had our little Nicholas, who's 5 months old, and believe me, we're into diapers.
I figured you'd be the expert.
As is Nicholas. Unfortunately, we're into disposables, as is most of the rest of the country. About 85% of the country are buying disposables as opposed to a diaper service. Like back in the 70s, when my Jeff and Jennifer were born, I was using a diaper service, but it's evolved to a point where disposables are the key, and there isn't a public company, believe it or not, that an individual can buy that's into the diaper service. Even Kimberly-Clark and Procter & Gamble have sold off their subsidiaries, and now we're talking disposables only. So I'd recommend, if you wanted to follow the demographic trends, stick with disposables, I suppose, and if Procter and Kimberly don't work, well, don't mess with me, because I can change stocks just as quick as I can change diapers these days.
Does Nicholas agree with this report?
Exactly.
All righty, if you'd like to get to the bottom of things, wipe the slate clean, wash your cares away, why not pin down our experts on how to clean up? I sure would cotton to you if you'd write to me here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at how the savings and loan industry has managed to become one of the nation's biggest financial problems all alone. A decade ago, in an era of comfortable regulation, the industry seemed healthy, with profits nearing $4 billion. But when Congress in 1980 began phasing out interest rate ceilings on savers' deposits, losses quickly followed. In the first flush of fuller deregulation after 1982, the industry moved back into the black. But more recently, a combination of overly speculative management and serious regional economic problems has sent the red ink gushing. So far this year, S&Ls have lost $9.4 billion. A decade ago, an S&L failure was a rarity. This year, nearly 500 went under in the first 10 months alone, with total losses nearing $70 billion. In days gone by, S&L losses were handled relatively easily by the insurance fund of the Federal Savings and Loan Insurance Corporation. But FSLIC, as it is called, has not been able to keep up with the latest disasters. Its fund's net worth is now estimated at minus $16 billion, a sum greater even than the net worth of its commercial banking counterpart, the Federal Deposit Insurance Corporation's insurance fund. How did this hemorrhage get so badly out of control? And how can it be stanched today? For some thoughts on that, let's go over now and meet tonight's special guest, Joseph Jolson. Joe, welcome. Thank you. Delighted to have you here. Please have a seat. Joseph Jolson has been fascinated by the savings and loan industry since his college days, when he worked as a lending officer for a thrift in Louisville, Kentucky. He later followed the industry for Fidelity Management and Research in Boston, and for the past 4 years as senior savings and loan analyst for Montgomery Securities in San Francisco. Joe, it was reported today that the Reagan administration has been unable to come up with a bailout plan, that it has dumped the entire S&L problem into George Bush's lap. What do you expect Bush to do?
Well, first of all, I expect him to thank President Reagan for that stocking stuffer. And beyond that, I think that he has to come up with two basic differentiated ideas. The first is he's got to stem the hemorrhaging that's already been taking place, which basically means he has to come up with the $30 to $50 billion check to close down the insolvent companies in the industry. Now, beyond that, he's going to have to go to the taxpayer and make sure that it never happens again. And he's going to have to come up with a consistent plan to do that in the future.
Okay, let's take those two parts one at a time. $30 to $50 billion. Why should the taxpayer pay $30 to $50 billion for bum management of S&Ls?
Well, it's not the taxpayer directly paying for it. It's the government's guarantee through the FSLIC to the depositor, which is the consumer himself, that their deposit is good up to $100,000 in principal and interest. Now, all the FSLIC is doing, or the government is doing by giving $30 to $50 billion is basically making good on its liability already, its guarantee.
And how do we avoid having it happen again? And specifically, who do you think is to blame?
Well, it's easy to point fingers when you have a crisis as big as 50 to 100 billion, and there are lots of culprits here. I think it's a combination of a lot of things. The industry was deregulated basically in the early 80s, and it didn't have the resources to cope with deregulation. At the same time, with budget constraints, they really cut back the staff of supervisors, and the deregulation process wasn't very well supervised. Then in the 1985-86, when the problems really first became known, Congress politically didn't want to do anything to upset the apple cart, and they sloughed it under the rug. Meanwhile, the negative problems compounded, and the losses grew from maybe 20, 25 billion to 50 to 100 billion today. So there's a lot of people at fault here.
We hear talk today that there never was a real reason for a separate S&L industry, and there certainly isn't in the future. Do you think that's true?
I've heard that talk also, and I think that any type of solution to the crisis will have to address that. My personal view on it is that we need a specialized housing sector in the United States. If you didn't have a specialized housing sector, there wouldn't be consistent funds available for people to borrow for homes. When the stock market would look good, people would put their money into equities and no one could get the cash to get a home loan, and vice versa. So there there wouldn't be the steady stream of credit available for people that wanted to buy a home.
Given the problems of this industry, is it a good or a bad investment?
I think that investors have to be very careful about where they put their money in the stocks, but as in a lot of instances, when things look their darkest, they're often the greatest opportunities. Back in 1982, the last time the New York Times ran a headline that the thrift industry is dead, in 2020 hindsight, that was the best time to buy into the industry, and I happen to think now is an excellent time to be looking at high-quality companies, primarily in California.
They haven't been affected to the same extent that those in the Southwest have been affected.
Well, there are some companies in California that have gone out of business like they did in the Southwest, but primarily the real estate market out there is very strong.
Why don't you give us some names in California?
Well, our top picks would fit into two different categories. One would be large liquid market capital, highly market capitalized companies. In that category, our top picks are Home Federal of San Diego, H.F. Amundsen and Company, and Great Western Financial. For the retail investor who can afford to take a little bit of a speculation and a little bit of a longer time horizon than some institutions are willing to do, we would recommend some smaller capitalization companies that also have the potential of a takeover in the stock. We'd recommend San Francisco Federal, West Corp, First Fed Financial, Union Fed Financial, and Bayview Federal.
Let me turn you over to a panel that knows it's smart to be thrifty, starting with Carter Randall.
One of the problems of the savings and loan industry, and there are many, as you point out, is that it always lent money long and usually at a fixed rate, and then its cost of money varied from time to time. And so they've reverted to something called an ARM, an adjustable rate mortgage. In the long run, is this good or bad for the industry?
Well, I think it's good for the industry because it basically alleviates their major problem of lending long and borrowing short. I think there are many adjustable rate mortgages out there that aren't structured properly, and one of the problems in many of those instruments, I think, is about to take place with payments for many people that took out adjustable rate mortgages in the last year scheduled to go up 10 to 20% over the next 6 months. I think there's going to be a significant problem on delinquency rates and credit losses, and probably a slowdown in consumer spending because of that.
Joe, you know, a lot of talk has been made about how some of these companies, insolvent S&Ls, have been taken over and presumably more money has been put into them and they've been rejuvenated. In your judgment, how strong, how favorable are some of these restructurings that have gone on, and how favorably would you view them from a long-term context as far as the industry is concerned?
Well, it's hard to make a generalization about that because there have been pretty good deals, but when you look at the failed companies and who acquired them, they basically fall into two categories. Someone that wants to run them as a business and knows what they're doing, and some people that think that they got a very good financial deal, not an economic deal, a financial deal, where they got the utilization of net operating loss carry forwards, they got guarantees against losses from the regulators, and they thought it made financial sense. The problem that those people have when they get into the door after they bought the company and they open it up at 9 in the morning is they don't have anyone to manage the institution. All the good managers have long since left, and they can't attract people to come to the company. So from that standpoint, I think the real shortfall there is finding good people to run, and they just can't find them.
Joe, let's talk about savings and loan stocks and interest rates. If interest rates peaked in the next few months, like I was talking about earlier, would that be a good time to buy them, or would it be too late?
Yeah, that's a good question. Typically, what happens is that everyone, including myself, for whatever reason, thinks that they can guess the exact day that interest rates peak. And on that exact day, when rates drop, everyone rushes in at the same time to buy these stocks, and they go up 30 or 40% in a couple-week period, and no one really makes any money in them. What we recommend right now is the aggressive purchase right now in anticipation of what you were saying that could happen over the next year, and people will be in them before rates drop, and therefore they'll be positioned to make that money. If they wait till rates actually drop, it'll be too late.
Joe, you say we've got to make sure this doesn't happen again. I'm sure everybody would agree that that's a desirable goal. How are we going to make sure?
Well, thanks for that responsibility, Lou. Basically, I think there's a couple problems. One is moral hazard in the savings and loan industry, and the moral hazard is on the part of the depositor. The depositor knows his deposit is insured up to $100,000 for principal and interest, and they don't care what the institution does with the money that they give them. Therefore, they're giving it to whoever pays the highest rates to them. So one of the things that I see happening is they have to address that risk. And a suggestion that I would have is only insure the principal, and don't either insure part of the interest or none of the interest. That would make the depositor, it would discipline them into looking into why that guy's paying 200 or 300 basis points over everybody else for the deposit rate if they knew that if he went out of business, they wouldn't get their interest, but they would still get their principal back.
It's been suggested that possibly different S&Ls should pay different amounts of insurance depending on the risk they're taking. Would you agree with that?
No, I wouldn't, because it's very hard to administer that. I don't think that it's easier to let the market administer the risk in the way that I just suggested. One way that...
In fact, we have to stop because our time's up. I want to thank my guest, Jolson, and our panelists for joining me tonight. Hope you'll be back with us again next week when we'll take a holiday look at some of the most beautiful things in the world. My guest will be Michael Ainsley, president of Sotheby's, the world's largest auction house. And we'll talk about investing in art and other things that delight your eye as well as your pocketbook. Get the picture? Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations. By CSX, the company that puts things in motion. Transportation, energy, properties, and technology. And by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts. Wall Street Week, Owings Mills, Maryland, 21117. That's $5 to Transcripts. Wall Street Week, Owings Mills, Maryland, 21117. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.